Good morning, everybody. Good morning. Can you all hear me? Good morning. And on behalf of the Association of Corporate Treasurers, I'd like to welcome everybody here this morning. It's wonderful to see everyone. And for those that I haven't met, my name is Artemis Galatis, and I'm the General Manager of the Association. And outside is my other half, and that's Deborah, who also helps. It's been quite a busy start to this year. We had the Global Ethics Code, a presentation about that, and we do ask the corporates, it was a very good presentation, to consider abiding and signing up for the Global Ethics Code. That was the previous breakfast. Looking ahead, we are looking to do a presentations on tomorrow's treasurer, what tomorrow's treasurer will look like and what they should know. There's also going to be a workshop on disruptive technologies, and also another workshop on technical analysis. So please, you're all on our database. You will be receiving details about it in an invitation. Also, we shortly will be asking for articles for the journal. Please, treasurers, do put your heads down and write an article. The title of we haven't really decided 100%, but I think it is going to be something along the lines of the disruptive technology and how we're all going to deal with that. In October, we're going to be having our conference, and the theme of that will be evolution towards a smart corporate treasury. So there's a lot happening going forward. But back to today's proceedings, and we are very privileged today to have Standard Bank and to have Paul Bocoin, who is the head of Treasury and Money Markets, Global Markets at Standard Bank Group. And Paul also represents the Standard Bank at various industry forums, which are focused on market developments. So this morning we will hear about the JIBAR transition to ZARONIA and what the reference rate means for your business. And corporate treasurers, I must say, we've been trying very hard in sending out questionnaires to which we haven't had a very good response, and I've been following up with telephone calls. And I think everybody was saying, we'd just like to wait and see what happens. Well, it's happening. So that's why I think we're having so many people in the room today, and I'm very, very pleased to see that. Okay, so Paul, over to you. And thank you very much for taking of your time. Thank you. Breakfast.
Thank you. Morning, everyone. Nice to see some familiar faces in the crowd and people I haven't seen in a while. And yeah, it's so great to have such a good turnout. Artemis, thank you very much for putting this together. So we're here to talk about JIBAR reform. I think it's filled some people with trepidation, some people with enthusiasm around a market development, a change in our market. So we'll just run through that today. Please, if you do have any questions along the way, happy to take them, but very happy to take questions at the end as well. So I think the LIBOR reform is fairly well established, but it's quite good to just look at some of the key principles and why are we going down this journey. That's a big question we get. You know, JIBAR works. Why are we all doing this? What are the benefits? So I think it's really been driven by the global FSB. So the Financial Stability Board of the G20 really looked at the LIBOR scandal and said, or the LIBOR post the LIBOR fixing scandal, where traders were potentially manipulating LIBOR to, make money during the financial crisis, and certainly that's well documented. What happened then is IOSCO, which is a standard-setting body, set standards around benchmark rates and said, well, what's the good qualities of a benchmark rate that that would give the market confidence, that would improve financial stability? So it's really around how do we make our financial markets more robust? And LIBOR really it was different to JIBAR. I'll explain how JIBAR works briefly. But LIBOR was really where banks said they could raise money in the interbank market. And as we know, during the financial crisis, banks heavily impacted. Changes in Basel really meant banks stopped lending to each other. The value of bank funding another bank is not really recognized in Basel. Corporate and retail deposits are much more valuable. So banks were really forced to kind of, fund themselves through their client bases or through wholesale funding markets and stand on their own 2 feet, not rely on interbank funding. And so the LIBOR market and the premise behind it and the liquidity in LIBOR disappeared. Now, furthermore, banks weren't really that keen to quote LIBOR rates anymore. There was risk associated with that. Why would you want to put a rate forward and have a regulator, question the rates, and you actually can't really defend the rate that's being put out there? And so there was a reticence to want to be a LIBOR contributor, where perhaps previous to that it had been seen as a badge of honor, 20 big banks contributing to LIBOR, setting the benchmark. So in addition to that, I think, so to make sure that there was an orderly transition, the regulator actually had to compel banks in the UK, in particular, to contribute to LIBOR. And they said, we'll only compel you until a certain date, but we need to move to something else. And so there was this drive from banks to want to stop contributing to LIBOR, and then a growing need to actually transition to something else. And that's across the major currencies. Fortunately for South Africa, we have a good blueprint now. We have a good blueprint on how to transition, and we'll run through some of that throughout this presentation. So that's some of the background. So South Africa, so we are G20 member. So one of our commitments to the G20 is reference rate reform, and certainly that's being driven by the FSCA and more particularly the SARB. So the SARB has set up the SARB Market Practitioners Group, catchy title, Market Practitioners Group on Interest Rate Reform, I think it's called. But it's just called the MPG. So you hear about the MPG. And we are now obviously looking at JIBAR transition, but also other rates that are benchmarks, like potentially SAFEX overnight, which will be widely used in this room. Is that a credible benchmark? Does it meet the IOSCO principles of transparency as being the key one? Is there underlying data that can support the rate? Being the two key ones. There are about 8 key principles, and if you want to get comfort around ZARONIA, I'd urge you to have a look at the IOSCO principles on rate reform. So we've spent a lot of time at an industry level trying to decide what the best rate is. What is the best risk-free rate in the South African market? Could we not use a secured rate? Could we not use a repo rate with a government security as a backing? That's what's happening in SOFA in the US. It's a repo rate backed by US government securities. But actually, in fact, in the UK, it's not that. It's an overnight bank deposit rate. So in fact, in South Africa, one of the most liquid markets is the bank call book. A lot of you in the room will have call deposits with the major banks in South Africa. So it's really, ZARONIA is built from aggregation of the call deposits above a certain size, above 20 million rand. And really they take all that data, they chop off the bottom 20%, top 20%, and the rump of that is how ZARONIA is calculated every day. To make sure that's robust, there's been extensive processes and data systems put in place. You can imagine the banks have got to compile call deposit rates across all their businesses and send that to SARB by 7 o'clock in the morning from the previous day. So it is quite a significant challenge, but it's been done, and it's been done in a very robust way. So what's the difference really between ZARONIA and JIBAR? So now we've got this overnight rate, and I think that will scare a lot of corporate treasurers. Now I've got a daily rate that moves around. How am I going to deal with this? And we'll go through some of that detail. Whereas JIBAR, I've got a monthly or quarterly fixing. I know what my interest rate is. I know in advance. I can plan my cash flows. ZARONIA, and I've got this daily compounding as well, an additional complication that's been introduced. But certainly this does align with global best practice, and certainly ZARONIA is got a significant amount of underlying data to it. I just want to reflect a little bit on JIBAR. I don't want to scare people about JIBAR. The first phase of this, ahead of actually even selecting ZARONIA as the successor rate, was to say, how do we make JIBAR more robust? So what is JIBAR? JIBAR is let's just use the 3-month rate. It's a 3-month NCDs that banks quote and would happily trade with you at, either to sell you papers, in other words, take in money from the bank into the bank, or to buy back that paper. So there's a bid-offer spread around that, and JIBAR is the mid-rate between the bid and the offer spread on say, a 3-month rate. And so banks don't have the same issue offshore as around conduct risk, around not wanting to contribute to JIBAR, because it's actually a tradable product that we offer to our clients. So there isn't that risk that JIBAR will suddenly disappear. But we'll go into when JIBAR might suddenly disappear and when it might not be credible anymore. And that's when I think we need to, this is why we're here, to start planning towards what we need to do for transition. So also the SARB at that time compelled banks to show much larger sizes for JIBAR fixing dates. So for an NCD, the major banks are compelled to quote up to 500 million rand per trade in JIBAR. So there's a strong commitment to making sure that rate is accurate and tradable. With ZARONIA, it being quite a, let's say, simple data set across multiple businesses, our business commercial banks, our corporate investment banks largely, it's quite a simple rate. So we've been able to gather more than 5 years of history now. So you're able to back test the rate, see how it's performed relative to repo, relative to JIBAR. And that allows various users to understand what this rate's going to look like and how it's going to behave going forward. And I'll touch a little bit more about that now. So we've just graphed on the left-hand side, ZARONIA versus 3-month JIBAR. You can see JIBAR is sort of predictive, not perfectly predictive of when rate hikes happen. You can see the 4 rate hikes or 5 rate hikes in this example that we've all lived through with our mortgages. And you can see how ZARONIA behaves. So it's much more like an overnight rate. It really tracks the policy rate quite well. So a lot of the work the SARB and the market practitioners group are doing through the data work stream and the derivatives work stream in particular are looking at how this rate behaves. What are some of the market fundamentals that are changing at the moment that could mean ZARONIA behaves differently to how it's behaved in the past 5 years? And I explain why that's important now. But maybe to go into a little bit of detail on that, one of the big changes has been the change in the monetary policy implementation framework. So previously, SARB implemented monetary policy by creating a shortage in the market and forcing banks to borrow from the SARB. And that became quite difficult for them to do in terms of how the shape of their balance sheet looked. So they looked at global best practice and they said, well, let's move from a shortage system where banks are forced to borrow into a surplus system. We can actually manage a surplus in the market much better. So now they create excess liquidity in the market and they ask banks to place that excess liquidity with them. So the banks will have a ability to place, up to, at the moment, about 100 billion rand every day with the central bank. And we place that at the repo rate, and that's how they can track market rates relative to that in implementing monetary policy. So now, with the market being in a very surplus system, by its nature, and banks being effectively compelled to place, between 10 and 20 billion rand, depending on the size of the bank, with the SARB, that's probably going to have a dampening impact on rates, because you'd rather do something else with that money. You'd lend it to your clients, you'd buy some treasury bills. So we've seen that actually. We've seen a drop in short-term rates, whether that's in the FX basis markets, rand dollar basis, or T-bill rates, or in fact even ZARONIA. So we've seen, as a result of these short-term rates dropping, some of the call deposit rates that banks have been showing dropping as well. So you are seeing that have an impact, and I'll explain why that's important now. So I think some of the other issues around JIBAR, while it is credible from the perspective that banks will trade at that rate, and they're compelled to trade at that rate, it's often the case that if you're doing a deposit with a bank, you're doing it probably at a better rate than JIBAR. So you guys will know that. You'll know where JIBAR is, and if you're doing a 3-month deposit, you'll probably expect to earn slightly more than that. So there's still not the underlying data and transaction volumes to support JIBAR. And part of that means that it hasn't moved with respect to interest rate expectations that you might have expected it to do. So you might have expected JIBAR to have a much smoother profile here as it predicted interest rate hikes. And so there's some concern that, is it truly representative of interest rates in the market? So I think we're moving to a new paradigm where we've got this probably a lot more complexity, but probably a lot more credible underlying benchmark, which should give the overall market a lot more comfort and bring us in line with global best practice. Okay, this is very small, so I will try and guide us through it. But this is the current draft plan. So the headline is JIBAR cessation end of 2026. So we're in 2024 already, so time is running relatively short. But I'll go through the slide in some detail, and apologies if you can't see it. I know there's a screen at the back, but I'll talk through it in a lot of detail. So what have we been doing so far? We've been in this foundation phase. We've been making JIBAR more robust. We've been adopting ZARONIA, so doing the work around making sure it's a credible rate, back testing it. ZARONIA is now published, as you'll be able to see, and beginning discussions with vendors. I know there's some vendors in the room here today as well, so that's great. But really, our system providers need to be able to use this rate and help us in terms of our interest calculations, the compounding, which will be for a lot of vendors that provide simple, products that we manage interest rate products on. This is a development they need to do. Fortunately, a lot of them will have done it now for LIBOR reform, so the mechanisms are very similar, but we need to compel the market to do this, and our infrastructure and system providers to support that. So there's a lot of vendor engagement here, and industry bodies like ISDA, ICMA, to get the standards out for how we're going to actually use this rate and to sort of drive development in the timelines. At the moment, you might have seen that the conventions for cash market products have been developed, and those consultations were issued, and those are now being published by the SARB. So you'll have a blueprint of what sort of best practice looks like for whether it's a bond, a loan, a money market instrument, and actually the derivative instruments as well. So those standards have all been developed and published. And ZARONIA has been added by ISDA, and that's important obviously for our hedging contracts. So the observation period ended towards the end of last year, and ZARONIA started to be published to the market. And it's available for use. So we are seeing limited usage of ZARONIA already, and it's really in the derivative market where the local banks, by and large, are testing ZARONIA, and that's quite important that we get liquidity in ZARONIA-based product before we actually embark on a transition. So now we're into this adoption phase. So we're sitting here in January. We've got derivative markets testing ZARONIA. We've got a fundamental shift in our derivative market. We've got a liquid swap market that trades 3-month JIBAR to fixed rate instruments. It's a big change for derivative markets. But in actual fact, it's probably a positive change because derivatives price much better against an overnight rate. Derivatives are margined. The margining will be against the margin rates that are applied are overnight. It's actually a lot easier ultimately not to have these fixing periods. The derivative market is probably going to be able to adopt this more quickly. And also the systems are just set up for this these kind of calculations, probably more sophisticated than a lot of treasury systems that are out there in the market. And so to really get credibility in the rate, we need this derivative build-up to kick off, and that's busy happening at the moment. But in addition to that, we actually our clients need to be able to hedge back to something. Now, if JIBAR is not going to be around, if you've got a fixed rate product, you want to swap it to floating, or you've got a floating product, you want to swap it to fixed, you need a liquid swap market to be able to do that. So we think the corporate market, the investor market, need hedging instruments to be available before we can really do the cash market conversion. So the priority has been to develop the derivative market. What happened overseas? We have you can go Google the Dear CEO letters. The FCA sent letters to the major banks in the UK, and that will include all the global banks that operate there, and said, this is a financial stability risk. We expect board-level governance to manage LIBOR reform. Tell us who your board-nominated person is who's going to drive this change, and we expect basically a full program to be put in place. But also we expect you to be the custodian of this for the market and support your clients on this journey. And one of the other key principles of that is we want this thing to be fair. So we want to minimize the winners and losers in a transition. And so banks did build very robust programs to transition away from LIBOR. And certainly all the local banks have done the same. So that's been the process that ended in June last year when LIBOR was discontinued. Mostly discontinued. I'll talk a little bit about that just now. So we're expecting these letters to come out, but they'll come out a bit more broadly than banks, I think. We expect it to largely hit all the financial institutions, so the fund managers and insurers as well, who will have big portfolios of JIBAR-linked instruments. It's important, for example, in the fund industry, a lot of the money market funds, the benchmark for money market funds will incorporate JIBAR in its benchmark setting process. And so they've got to go and reform all their benchmarks on how they manage their own performance. Like income funds will say, we'll outperform JIBAR +2. What are we now going to outperform? ZARONIA plus what? And we'll talk a little bit about what that what is now. So there's a lot of change in the industry space, and you will have interactions with fund managers who manage some of your liquidity. So they're going to need to be able to articulate to you what they're doing, make sure that's credible as well. And also the instruments they buy. A lot of the guys will be buying bank paper. We've got to make sure that paper fits the new standards. So this communication will come out shortly. We expected it probably a little bit before now. So perhaps we 2-3 months behind on this timeline. And so there'll be a wide communication from the central bank, from SARB, around the cessation of JIBAR. And that should be out quite shortly. There'll be another JIBAR seminar, probably held in Johannesburg in August this year, around that sort of timeline, and SARB are putting that together at the moment. So hopefully we start to see this liquidity build up during this period, largely compelled now but from a regulator saying, we believe this is a financial stability risk. We will be announcing a JIBAR cessation date at some point. The JIBAR cessation date won't be announced now, and I'll explain why. So get prepared, and your boards will need to drive this change and really catalyze the change through the market. At some point, we need to look at, can we commence a ZARONIA first initiative? And so towards the end of this year, this is November, do we have enough liquidity build up in the market to, at an industry level, so let's say the derivatives working group of the market practitioners group say, actually we've got enough market participation locally and internationally to start only using ZARONIA for new transactions. That helps us then create a backbook of JIBAR transactions. That's very important. And fortunately for derivatives, a lot of those will run off quite quickly. So we can reduce the requirement for transition quite a lot by just saying, let's only do ZARONIA from this point going forward. And so in the derivative market, we'll see this ZARONIA first initiative kick off. Other critical factors. Derivatives are now cleared in a lot of cases, and we need the market infrastructure, so LCH being the biggest derivative clearer, to be able to clear ZARONIA derivatives. That will bring the international market into the fold, but also the methodology on fallback is going to be quite important. Now, what is fallback? So if JIBAR becomes not credible at any point in time, your contracts will say, we need to fall back to another rate. And within your contracts, it will probably say, go get quotes from different banks, or prime minus a spread, or something along those lines. What this global standard is now saying, introduce fallback that transitions to the new benchmark rate. So in your new contracts, your fallback should say, okay, I may still need to do JIBAR now, but if JIBAR ceases to exist, let's fall back to ZARONIA instead of something that banks don't want to quote you guys 3-month rates to help you in your contracts. It's not good use of your time or our time. And some of them won't have any fallback language, so you're going to have legal and contractual problems on how you resolve that. So I'd urge you to look at your contracts and see what your fallback arrangements are, and actually you can amend your fallbacks with your counterparties already, probably to incorporate ZARONIA. It's much easier to do when the market agrees on what the spread between JIBAR and ZARONIA should be. And that's the purpose of doing this 5-year look back on what's happened with JIBAR and ZARONIA. This is obviously not 5 years, but what is that? And so the market really says, okay, well, certainly there is the methodology which has been widely adopted for transition globally. Said, okay, what's the spread been between 3-month LIBOR and SOFR over the previous 5 years? Okay, that was 26 basis points. Let's use that as the fallback spread for derivatives. And actually then the derivative market, the basis market between LIBOR and SOFR swaps started to trade around that point, around that 26 basis point level. So the market then got a lot of comfort in well, okay, that's an agreed spread that we're happy to transition at. So your contracts could say, let's transition, let's build in some fallback language in case JIBAR's not there, or post-cessation it's not there, that it automatically goes to ZARONIA plus that sort of look-back spread. The reason I brought up that monetary policy implementation framework, it might be that we may need to adjust our spread because of the impact the monetary policy transmission mechanism change has had on that spread, and that's only been over the last 18 months. So the markets, that's a bit of detail, but I think I take comfort out of the fact that there'll be academics looking at that, the SARB, a lot of people will be looking at the appropriateness of that fallback spread. That's important because that makes it as fair as possible in terms of how we're going to transition to make sure that there aren't material winners and losers. Okay, so term rates. Now, I don't want this daily compounded rate or even simple rate. You could agree to deviate from the stand and say, well, I can't do compound, I need to do a simple rate. You'll be able to do that. You can actually probably do whatever you want other than use JIBAR. But in terms of your own risk management, tracking where market rates are, a lot of corporate clients will say, I really want a term rate. And so you'll see term SOFR being published. The market is certainly looking at what we could do to create a term ZARONIA. So in other words, how could we create ZARONIA fixings that are credible. Now that's the key point. How do you make sure that the term rate is credible? So what does a term rate imply? It's either going to be backward looking and say, okay, well, let's look at what happened and fix on a retrospective basis, or it's got to be forward looking. The global consensus has got to be forward looking, but then I need instruments that trade that are forward looking against ZARONIA. So I effectively need a swap market or futures market to build that has liquidity based on ZARONIA instruments that I can reference to build a credible term rate. So I can have a decent stock of underlying transactions that support that. Canada's going through a problem at the moment where they don't have that underlying stock. So their term replacement rate, I forget what it's called, that replaced CDOR is under pressure, and they're either going to have to withdraw it or come up with a different approach because they don't have sufficient derivative liquidity to reference it. So I think our regulator's taken the stance that says, or let's say the SARB market practitioners group, which is really guiding the market through this change, said we need to be able to deal with the fact that these term rates might not develop as quickly as we'd like. We have a less sophisticated market than the US and UK. We do have a very liquid and I would argue sophisticated market, but the depth in derivative trading is not as obviously as significant as those markets. So it's important for us to say our market needs to be able to understand and develop these overnight rates and use them, and we will commit to looking at a term rate, but we need the markets to develop, and there might be a lag in terms of these transition timelines. So now, middle of next year, your banks, your other counterparties are going to say, well, are we ready for this ZARONIA first initiative? So can we stop using JIBAR as our primary underlying reference rate in our contracts for our floating rate contracts? So we need a lot of these liquidity things to be in place. We need the market to be comfortable that they can transition. We need the system vendors, the infrastructure vendors to be able to support a ZARONIA first initiative. And then from that point, the SARB or the MPG will say, well, guys, as a market, let's use ZARONIA and not use JIBAR. Banks will be, I think, I don't want to say compelled, but there's now this top-down regulatory review around your stock of JIBAR contracts. Is that growing or shrinking? How are you doing relative to your peers on, propagating ZARONIA into the market? So there will be some pressure, I think, from the banks to drive this transition, and some pressure on the banks to drive this transition. This is not like a willing transition, if you know what I mean, but it's necessary. It's necessary pain to go through. And so that cash market fallback methodology is important, and I think you'll have a lot of discussion with your banks, with your advisors on, one, how to implement that, two, what it is, how to explain that to your boards on what the financial impacts of a transition will be for me. And quite frankly, you want to avoid as much transition as you can. So early adoption of ZARONIA is probably not a bad thing if you're confident that the pricing makes sense to you. And there'll be a lot of work to do with our clients around how that pricing works. Okay, and then we have a very short transition timeline. So reducing the stock is really only 6 months, and then we start to commence active transition. So that is when you will hear from your counterparty on a transaction. You have a JIBAR-linked transaction. We need to do something about this, and how are we going to do that? And so your relationship managers will be in touch, or your counterparty for a particular product, and we'll need to kick that off. These fallback protocols will obviously be in place at that time. And that's the point where I think SARB will say, we are formally announcing the cessation of JIBAR. Why don't they do it now? Well, that kicks off a lot of implications for everyone here. If you announce cessation of JIBAR now, guess what? You've got to go and report you've got to do disclosure around that in your financial reporting. It may trigger some legal consequences around, if there's a cessation announcement, you may need to actually switch to a fallback rate. So there's a lot of implications that, and perhaps some unintended consequences of announcing a cessation now. So the consensus is to delay the formal cessation announcement. And so towards the end of next year, we'll see the cessation announcement. And then at some point be kind of more no new JIBAR. We do not expect JIBAR to be used going forward. And then as we saw internationally, we may want to stagger this. We may want to say, let's do like 1 month and 6 month JIBAR. There's not a lot traded there relative to 3. Let's treat that as a trial run and test the pipes, as it were, for derivatives, for cash market instruments. Let's set an earlier cessation for that deadline, and so we can get a smaller volume of transactions done and test how that works. And that'll, I think, benefit the market as a whole. There are very few transactions linked to 1 and 6 months, but at least a lot of the market and the market infrastructures and service providers will have an opportunity to iron out any kinks. That certainly was very beneficial for the LIBOR derivatives transition, which is largely led by LCH, who scheduled transition weekends, and the whole market transitioned over effectively 1 weekend with a fallback weekend for those who didn't transition. So literally the whole stock of cleared derivatives switched over, let's say, 4 weekends, one for the non-3-month tenors, and then the major one being in, I forget, but I think it was May last year. And then we've got this tough cessation date here. So these are quite compressed timelines, and I think it's important to comment into the process. So there'll be a consultation around this announcement here. I think it's important to reflect on this and comment into this process. This is quite a compressed timeline. So I think is obviously to some extent we're falling behind the rest of the world because most other markets have transitioned, or the ones who have elected to transition have done so. So there's this sort of compulsion at that sort of G20 level to really keep up with the pace of things. So now we've got cessation, and it's happened, and you still have JIBAR contracts. What do we do now? So you're going to fall back to whatever your legal contract says. So I hope you've got ZARONIA in there, or if you've got something else, you'll fall back to that. Or if you don't have anything, and JIBAR is not published, it might say just use the last JIBAR rate. And then you've got a fixed rate contract because that was the last JIBAR that was published. So how do you manage that? 1, you get prepared here. 2, you change your fallback if you're concerned about it. And then actually the regulator is looking at what to do about this. And they certainly did this internationally. So can you create legislative or regulatory processes that say, for stuff that hasn't transitioned, let's create a legal mechanism that protects both parties, that the appropriate transition is to ZARONIA plus the fallback spread as an example. So avoid litigation in that regard. Or do we put a JIBAR, a kind of, I can't remember what it's called, maybe someone can help me. So for LIBOR, we've got synthetic LIBOR, right? So we've got synthetic LIBOR, which basically says, okay, well, for a year, or just over a year in certain cases, we'll publish a synthetic LIBOR rate. It's actually built off ZARONIA plus, or it's built off SOFR plus the fallback spread, and we'll publish a daily fixing of a 3-month LIBOR, which is actually linked to the fallback spread. So for contracts that you haven't managed to transition, there may be this opportunity to let them kind of just run off, linked to a synthetic rate. There's no commitment on that. And you can imagine why not, because everyone would just say, oh, okay, cool, I can carry on with my contract, and I'm going to have the synthetic JIBAR forever, and I don't have to do anything. So there's obviously potentially parliamentary processes. I think it might be difficult here to get change through Parliament, as you might imagine. So there's potential delays on getting these types of things in place as well. So I wouldn't hang your hats on there being a full suite of legislative protections for you or the banks. We certainly can't do that. And also whether the SARB feels that synthetic LIBOR is actually, a JIBAR is actually necessary. Okay, that was a lot. Take a breath. That's the meat of it, you'll be pleased to know. And then the final slide, just thought to reflect on, just like, what do you think about in your organization? So some of you would have gone through LIBOR transition, some of you be part of a big group that's gone through that, some of you won't. And so what are some of the things that you need to consider? Certainly the banks have all put, as I said, quite big programs in place to manage this. We'll have a program dealing with communication, both internally and to our clients, and sort of broader market communication and awareness. We'll have a piece of work that looks at our systems and products. What systems, products, and models. You can imagine lots of financial models that have JIBAR as an underlying assumption, or swap curves that have JIBAR as the underlying base. You've got to rebuild your whole swap pricing from now a ZARONIA base where you've had JIBAR as your build-up for your swap curve. That's a big change. You have a legal work stream that looks at repapering your contracts with your transactors. You need to measure this. So what stock of JIBAR stuff do you have? What fixed rate deals do you have that maybe in the future swap to floating? Or in the event, so there's a lot of underlying legal work to do to try and unpack where JIBAR exists in your organization. And then what are the economics of this? So if I understand what the fallback spreads are, there might be an active, or there probably will be an active ZARONIA JIBAR swap market for a period of time. Do I understand what this fallback does to the economics of my loan? And am I in a point to negotiate with, in an active transition case with my bank or my other financial service provider? Or do I understand what this means for the investments I have if there's suddenly a shift in ZARONIA and I need from JIBAR to ZARONIA? Do I understand what that's going to do to potentially the performance of my investments? And then accounting, tax, legal, they're big implications. I think financial reporting is a bit thin here. There's obviously all the hedge accounting implications of this. Certainly, I am a former accountant or a reformed accountant, but we obviously do a lot of hedging within the Standard Bank Treasury. There have been some safeguards put in place by the accounting authorities for this to basically say if it's, if you're transitioning from LIBOR to SOFR, that's not a new hedge, so you don't have to go and re-document things and things like that. So certainly that will come through our accounting standards as well. I would think, and certainly that the accounting and tax work streams busy kicking off again at the market practitioners group level to understand all the implications. We'll certainly work closely with the audit firms and advisory firms here around that. We spoke a little bit about this, but this is probably for companies that don't have sophisticated systems, or maybe your system is 10 versions old. It's going to be quite difficult to put some of these in, and you start working on Excel again, which probably not a good thing. So I think engaging with your vendor early around, are they ready for this? Have they seen it? Are they keeping up to date? How will this work in my system? Testing, all of those sort of things is going to be quite important to go through. Probably during the second half of this year, I'd suggest is probably the appropriate time, and perhaps into early next year. And that's all I have. Any questions?
Behind you, Sheila.
Morning, Paul. Just a question around term rates, essentially, but what's the volume of transactions that currently references 3 months JIBAR? And is it a case of that not being deep enough to create a forward ZARONIA, or that not all of those are expected to require a forward rate going forward?
So it's a good question. So the JIBAR will cease to exist because there aren't sufficient transactions underpinning it. If you look at the size of the derivative market, which is billions and billions, there's probably $1 billion or $2 billion a month going through in 3-month JIBAR. So it's really this huge inverse pyramid, which creates the financial stability risk. If there is any kind of credibility issue around JIBAR, that's the risk we're trying to avoid. So I think that's the key reason that JIBAR is also then not an appropriate solution for a term rate.
Paul, sorry. What's National Treasury's position on issuing these instruments? Because it sounds like you need some kind of benchmark to create a curve of liquid instruments. And they seem like the obvious place to start with creating these.
Yes, they do seem like an obvious place to start. I'd suggest that you're going to probably see the banks issue before you see National Treasury issue. They certainly are part of the process, but probably more at this stage from a governance perspective than looking at the issuance plan. We haven't had a direct dialogue with them. I don't know. They obviously are issuing floating rate instruments into the market now. I think that is a necessary engagement. I don't see them as being a catalytic early adopter. That's my personal view, and maybe I'm not part of those conversations. But it's potentially the development finance institutions, if they feel they can support local issuance in ZARONIA. We saw that with, for example, IFC doing some of the first issuances linked to SOFA or Shaw and SONIA. So it may be that we need that support, but I think the banks as major issuers will probably quite quickly adopt this in money market instruments and bonds, and probably be that catalyst.
Hi, Paul. Thanks for the presentation. If I understood your timeline correctly, it was almost a move of the derivatives market first, so the cessation of JIBAR kind of in that space. Is there a risk for, particularly, I guess, the treasurers here, that you're going to have your derivative hedges moving to the reference rate changes, but your underlying loans or whatever it is you're hedging kind of delays in the cessation on that, and kind of introducing hedging risk into that?
I would say yes, but it needs to be carefully coordinated. So there will be obviously some overlap, and I think this adoption phase covers both instruments, but at no point, I think, is anyone compelled not to trade JIBAR during this period. It's really when you get to kind of no new JIBAR closer towards the cessation date. So you'll have this adoption phase of building up liquidity. At this point, for your new transactions, you will probably, so I think it's a very good point, but let me try to answer it a bit better. It's really only towards the end of cessation where you're going to be compelled not to use JIBAR. So I think if you're doing a hedge at that point, you're hopefully comfortable with ZARONIA as the underlying rate if you're hedging from fixed to floating, or you have a ZARONIA product. If you have a JIBAR-linked product, you will still be able to hedge it using JIBAR. So even after this no new JIBAR rate, and you've got the regulator looking at effectively conduct now and the drive towards financial stability, banks were still able to quote, let's say in the US example, LIBOR-linked swaps to reduce the stock of LIBOR-linked risk in the market. So they were able to quote on those instruments, but only to reduce the stock. So we would have to report on the instruments we were trading linked to LIBOR and actually explain at a transaction level why we were doing it. And it was to reduce that stock of risk. So that certainly will, I'm sure, be part of our framework. That should give you some comfort. But you can't imagine your pricing is going to be great because there's kind of no liquidity left in that market.
Paul, thanks. Question from my side here in the back.
Sorry.
Maybe more from a practical point of view. So if I understand you correctly, there's not yet a term rate, so like 3 months JIBAR. So you have a loan, a 3-year loan that resets at 3-month JIBAR. It will now have to move to the ZARONIA plus that spread that you mentioned, which is also not known yet, the 26 basis points LIBOR example. And we're also not sure is it going to reset backward-looking or forward-looking because that term market has not been determined. Is that the correct understanding? Because you cannot be placed in a worse or a better position than what you were when you took out the loan.
Correct. So the fallback, wrong button. The fallback methodology will be determined towards the end of this year. So I don't think you'll be trading ZARONIA linked product before you understand that fallback methodology. That fallback methodology will set the spread, and then you'll have a sense of that spread makes sense relative to JIBAR, etc., and be able to interrogate that. So you'll need that information before you'll be comfortable to trade ZARONIA. And so I think there's a sequencing here. So we're not saying go out and trade JIBAR tomorrow. What we are saying is understand within the conventions that are being published what those transactions will look like. There will be the spread. We don't know what it is. We didn't know for a long time in LIBOR what it would be. In fact, there were traded spreads that were quite different to where it ended up coalescing around that 5-year look back. I think we have that blueprint now, so you'll probably quite quickly see the market coalesce around that 5-year look back kind of spread, adjusted for any nuances we have in our market. So I think it is just important to, one, understand the contractual side. Yes, you are going to struggle not having a term rate for some time, I suspect, and that's the guidance that SARB have given. Don't assume there's going to be this term rate being developed, so get comfortable with the overnight environment and some uncertainty around cash flow, because these rates will move and move like a prime rate would, kind of thing in terms of how policy rates move. I'm sure that doesn't seem to fill you with a lot of comfort, but that's the state of play. Yeah. Yeah. Hopefully it's not a black hole for a couple of reasons. One, you should have the ability to forecast because you will have a swap curve, right? And you will be able to see what interest rate expectations look like in that market. So you'll have this overnight index swap now as opposed to a JIBAR swap market. So you'll be able to see what the market certainly expects interest rates to do. And from that, you can infer what the policy rate moves are, and that's how the markets behave. So, and then contractually, I think these will probably pay monthly or quarterly. The trick, and so those conventions are available to read, and there are nuances in them. So I would urge you to read them. The setting might have a lag. Say, okay, well, we're going to set based on the rate 5 days ago. So there's little details to work through and how that works. But certainly in terms of interest payments, you won't be settling interest monthly, maybe compounded daily and settled like monthly or quarterly. So there'll be, those conventions are available to read at the moment.
Yeah, okay, I think my answer was, my question was answered on your last statement there, because like I was going to ask, will the ZARONIA mimic SOFRA's conversions terms to the T, where we have the lookbacks, the payment delays, and all those fancy stuff in it.
Yes, all that fancy stuff's in there. The one point to note is it's as uniform across different products as possible, but there are nuances between bonds, loans, and derivatives that suit those products in those markets. And certainly, I'm sure the financial services firms would be able to guide you through that as well. There will be a document, those documents that are published actually highlight some of those differences in terms of the derivative market probably won't ever look back. The cash market probably needs one because operationally it's a bit more difficult to manage. So I think there are nuances, and I think just to highlight, and I don't know them offhand, sorry, I should, but there will be differences between bonds and loans, for example, as well.
Thank you for the presentation. I just want to find out from you, the credit spread or that spread that they're going to add to ZARONIA to get the difference between JIBAR and ZARONIA. That you're probably going to do on all your existing loans, that nobody is worse off, that everyone is still in the same position. And in the future, if you negotiate new loans, you're probably going to include that spread so that you make more or less the same money. So are we then not artificially getting back to JIBAR?
I will try to answer that question based on what we saw happening with LIBOR. So LIBOR's got an embedded credit spread in it, 3-month bank risk, as does JIBAR. So JIBAR trades above repo. In a flat rate environment, JIBAR's probably 10, 15 basis points at the moment above repo. And that's a credit or liquidity spread. So if you have a look back, I don't have the numbers, but let's assume the 5-year look back is 15 basis points. Now that would, if you're on a bank's balance sheet, that would apply on all our JIBAR-linked liabilities, all our JIBAR-linked assets. We may have more JIBAR-linked assets or liabilities, so the banks will make or lose based on that difference. But the critical point is we now have an overnight rate and we have this credit adjustment spread, and it's standardized. And it's based on a look back, yes, so it's not forward looking, so it doesn't take into account what you would expect to happen to that spread over time. But some of these adjustments that we're looking at really say, okay, well, what's happened in the recent past, and do we need to add a recency bias for some of the recent market developments? So are you getting back to JIBAR? No, for a couple of reasons. One is JIBAR's probably not that responsive to market moves. This rate will move as and when policy rates move. It tracks the policy rate very closely. And that the addition of that credit adjustment spread, what we've seen is that it was important for transition, and it was important during these first few contracts that we were doing here. It's actually largely fallen away. So you found that now being just built into the credit spread charged on a loan. So you don't actually separately quote a credit adjustment spread. So it's really become a transition tool, and you'll actually see it fall away. Does your credit spread go up? Yes. Does it go up the full amount of that differential, that 15 basis points? I don't know. The market has just evolved so that you trade at SOFR plus a spread instead of SOFR plus credit adjustment plus credit spread, if you know what I'm trying to say. So I think that will probably be the natural evolution, that these credit spreads, it actually happened quite quickly, that clients will say, well, why are you putting this credit adjustment spread in my loan? Like, what is it for? And we go, okay, well, it's very hard to articulate what it was for. It was useful during transition. Well, let's just get rid of it. So the whole market kind of really got rid of it. But yes, there is some inherent risk banks take around liquidity risk. And so we will still pay SOFR plus a spread for 3-month money. We're not going to pay SOFR flat. So that kind of gets built into, and you really then need to look at, what is your overall cost of funding? How do you price for loans? So it becomes a much more amorphous thing, really hard to articulate. But I think that that is where, market dynamics and market forces will determine where ultimately credit spreads get set as a spread over ZARONIA. So I think it's a convoluted answer, but a lot of it will be determined by how the market evolves and how money market rates are quoted as a spread over ZARONIA, how bonds trade as a spread over ZARONIA, and that will feed through into the corporate loan pricing, for example.
It was really very comprehensive. I mean, from LIBOR reform to JIBAR reform and the timeline. Thank you very much, and it was very comprehensive. Even I understood some of it.
Thanks, Otis.
On behalf of the association, thank you very, very much for addressing everybody, and corporate treasurers and those in the financial markets. Please, is there any further questions, you can address them to Paul afterwards. They have got permission to actually distribute the slides to everybody, so all the attendees will receive them. And once again, thank you to Standard Bank.
Thank you, Otis.
Good morning.
Thanks for having us.